Well, welcome to another episode of the Property Now podcast brought to you by Composite. I'm Michael Carbone. My friends call me Carbs. Sitting with me today, it's one-on-one. I'm here with Aidan Hartley from our home loans, mate. The on LinkedIn, you're calling yourself the first home buyer's mortgage broker. How'd that start? First home buyers, so if a second home buyer comes to you, you say, no, sorry, not interested, or how's that all work?
Good question. So I probably started about 6 years ago on LinkedIn. And very similar to everyone else, I was very, very broad, let's say. So I was speaking to investors, to refinancers, to upsizers, downsizers, first-home buyers. And I think the reason I picked first-home buyers was purely because I enjoyed working with them. Yeah. There's nothing better than getting someone their keys to their first property. And to your question, we do get a lot of inquiries around, can you help me with a refinance? Can you do investors? And of course, if you can do a loan, you can do a loan. Yep. So, yeah, we wouldn't turn it down, but the marketing is focused more so on first-home buyers because that's who we like working with, and that's helped us get to where we are today.
It makes sense, right? That excitement around owning your first home. There's nothing quite like it. And they need the most help. They haven't done it before. There's a lot of questions, and you probably, love having those conversations, I assume. What percentage do you think of those first home buyers? And we'll get into, the reason you're here is a LinkedIn post that I really liked, which was the 10 Commandments for first home buyers. So we're going to unpack each of those. But before we do that, I really want to understand of the first home buyers, because a lot of first home buyers now, they're not actually buying their first home to move into. It might be an investment. I remember even a long time ago now, but my first home, my brother and I, we bought an investment property, never lived there. And that was my first home. Do you see a big cross section of like people moving in versus first home as an investment?
Yeah, there's been a big trend switch. So I've been in mortgage broking for 13 years, and probably until around 2020, 2021, I would say the tide turned. So previous to that, almost everybody would just save a deposit. They would buy a home. They would live in it. Once they paid it down, built enough equity, they would then potentially consider buying an investment.
Yep.
In my mind, a lot of it was, during early 20s, we couldn't really go too far. So a lot of people were then moving to potentially looking to buy interstate. They were seeing better value. If they're in Sydney, they were seeing better value in Queensland, Victoria, WA. I think a large part of that as well is the rise of buyer's agents.
Yep.
So there's a lot more information around there. There's a lot more education around buying where it's best to buy and living where you want to buy, because if you're living in Bondi, unless you've got $3 million, you're probably not going to be able to buy a place in Bondi. So we're probably seeing around, there's still the vast majority still buy their first place to live in, because all of the government schemes are they're tailored towards first home buyers to live in.
Yep.
But a lot who are priced out, we're probably doing around 1 in 3 would be rent vestors, as we call them, where they're renting where they want to rent, and then they're buying where it makes most sense.
You're seeing more of that with the education piece, the TikTokification of broker advice as well. So this term rent vesting has really become a big thing. So and I'm seeing a lot of people take advantage, and we're seeing certainly at Composite, Sydney's hard. It's hard to get in Sydney. So where else everything else kind of looks affordable to a Sydney sider, which is pretty cool. But let's jump into the 10 Commandments. So commandment number 1, I feel like Moses with the tablet here. But number 1, you don't need to have a 20% deposit.
Yes. If anyone takes anything away from this podcast, I think that fact that you do not need a 20% deposit, you see a lot on the news, you see a lot in the media, and a lot of it says it takes the average first-home buyer, and they give a number of years. So it might be 12 years, 15 years. But I mean, it's pretty ridiculous, because these days you can buy with as little as 5% with a lot of the government schemes now. And even we do a lot of guarantor loans. So we do get help from not the bank of mum and dad, but the property of mum and dad. And essentially you can buy with literally zero deposit. So if you've got no money to your name, as long as you've got an income to support the ongoing repayments, we can jump in with no deposit. So that's going to save you years.
And how's that work, the bank of mum and dad or the house of mum and dad? How does that zero, because I mean, people are going, I don't need anything. I just need to be able to service it. How does that actually work? Let's get technical with that.
Well, in terms of guarantors, so I like to think of it as collateral. So if we have, let's say, for example, you're buying at 700,000 and you want to borrow the full purchase price. So you can literally borrow 700,000. Now, the banks traditionally want at least 20% equity in the property or 20% deposit. That's their general level of comfort. So they might lend you 80% of that. Whereas if a parent, and I typically say parents because 95% of the time it is mum or dad or both. But we're doing a lot now. Even sisters and brothers are helping where they've jumped in 5-10 years sooner. They've built up equity and we can leverage against it. So in terms of when we're doing a guarantor loan, it's all about collateral. So again, the 700K purchase price, 700 property, bank's not comfortable. So what we do is we add in a second property and then the bank has more collateral in case you default. And then all of a sudden they're happy to lend against that value. Wonderful product. You save lender's mortgage insurance. Yep. You get interest rates as if you had a 20% deposit. Yep. And the main thing is time. Yep. So you can jump in years, if not decades sooner.
Yeah, it's so good for parents to be able to help their kids out that way. Are there any things that parents should be looking out for there? Like all of a sudden their home is tied up. If their son or daughter can't make repayments, there might be an issue. What advice would you give to parents who are looking to help their kids out in this way?
So normally I speak to the borrowers and then I separately also speak with the guarantors. And I think, and I didn't used to do this because I would just, take the information, get the documents from the guarantors and away we go. So now I have a separate conversation with the guarantors. Yep. It takes 10 or 15 minutes. I can run through exactly what it looks like from their perspective, the pros, the cons, the risks, what it requires from them. And it can tie them up somewhat because we want to remove their offspring, son, daughters, as soon as possible. So we can remove them when they have 20% deposit. And there's two levers we can pull in order to get that 20%. One is, of course, you paying down the loan, which to be honest happens pretty slowly. Yeah. If you've got a big mortgage, the first few years are very hard because the majority of those repayments are going to be interest. So you're not paying that down too quickly. Yeah. The other one is the rise of the property value as well. So typically, if we buy at 700, you might pay 5% down. The property might grow 15%. So then we have the 20% equity and we can release the guarantors. So we just want to make sure the guarantors have no plans to sell the property, because if we remove the guarantor, the bank will want to reapply the lender's mortgage insurance. So it defeats the purpose of doing the guarantor in the first place. And it can restrict them from refinancing because we'll have a mortgage against their property. So if they want to switch banks, it can limit them from their side. So we just want to make sure they've no plans to pull out cash, refinance or sell the property. Again, piece of string question, but normally we say between 1 and 5 years.
Yeah, okay.
Depends on how quickly they pay it down and the rise of the property value.
I guess the other thing that a parent should consider is if they've got 2 kids that are looking to buy, can they help out both? Do they help out one and the other? What's that time frame look like? You mentioned LMI, and so the second commandment is LMI: avoid it if you can, pay it if you must. I didn't know you didn't need LMI if your parents if you get a guarantor for the full 100%. So that's really interesting. Yeah. But tell us about LMI. How do you avoid it? And if you have to do it, is it such a bad thing?
Yep. So LMI is probably the third or fourth option we go through. So normally, if you don't have, normally we try and get you to have the cash deposit. That's the easiest and simplest way. If not, we'd look at any potential government schemes. If not, we'd potentially look at the guarantor option. If not, then we'd look at the lender's mortgage insurance option. So again, that's typically if you have less than a 20% deposit. The banks will apply a premium. It's normally around 1 to 3% of the loan size. So let's say it's 700K, it could be, depending on how much deposit you have. If it's a really small deposit, it could be more like 3%. Yep. If you have a bigger deposit, still less than 20%, it could be around 1% of the price. So let's say 700,000, it could cost between 7 and 21,000. However, if your property goes up 30 or 50 or 70,000 in that same time, you're still laughing. So
you kind of covered it.
Yeah, I just think of it as similar to a stamp duty. It's the cost of doing business. Sometimes it's just a means of you getting in the market today, paying today's prices
Yep.
instead of prices in 3 or 5 years, which are probably going to be 50, 100,
Yeah.
200k more than where they're at today.
It's interesting. If you don't pay the 20, you might kick yourself if it goes up 70, and that gets tacked on to the actual mortgage, right? So if you borrow 700, you'll need to borrow 720. Yeah,
Absolutely.
Or whatever.
We normally capitalize it into the loan.
Yep.
So you can, in theory, pay it separately, but yeah, there's a whole story behind this. But long story short, it makes a lot more sense to actually capitalize it into the loan.
Yep.
It reduces what we call the loan to value ratio, which it just gives you a lower lender's mortgage insurance premium. So it's actually more cost effective to have it in the loan than to pay it separately.
That's great. All right. Commandment number 3, pre-approval first, always. I would find it crazy to think that people wouldn't get pre-approval before they go and actually make a buying decision. But it obviously happens because you've got it as a 3rd commandment. Tell me.
We see it a lot. So normally it's a frantic message on a Monday morning.
Yep.
So often they've got carried away, they've found a place they fall in love with, they've done some online calculators which are at best volatile and not to be relied upon. We'll get a message, I bought a property on Saturday, can you help me get the finance approved? And it's obviously my job to find a way to make it work, but it carries a lot of risk because you're basing your finance on some random online calculators. You haven't actually ran through the application. Either that or they've applied online. So they've gone to some random non-bank or they've gone to a online only lender and they've got a pre-approval in 60 seconds. Yeah. But if you've put in the wrong information, it's garbage in, garbage out. So often those pre-approvals cannot be relied on. So it's either they just haven't got it or they've got a pre-approval that's just not worth the paper it's written on.
It's interesting. People don't realize that the online calculator is typically a fun part of a marketing funnel. So it helps you get a rough understanding, but the idea is for you to come through and start to ask more questions, and then you can solidify, what your actual pre-approved amount would be. But some people take it as gospel, I guess, and that's interesting.
Well, they do. So probably the most common ones would be the online calculator will say, what is your salary? So your salary might be 80K.
Yep.
But if you haven't ticked HEX, that's going to reduce it. If your salary is 80K inclusive of super, you're going to have to deduct the 12% for super. It's more like 70K. So, all of a sudden, an 80K salary that you put in online could be 70K minus HEX. It could be 68K.
Yep.
So that extra 12K, you've almost fudged the own figures. And that 12K, normally we're looking at around 5 times multiplier now for borrowing power. So that could be 60K. You've over leveraged what you thought you could borrow. And then where do you get that money from? Which is normally where I get the frantic calls on a Monday, and I've got to find a solution to get the finance approved.
Sounds like fun, and it's always on Mondays, right?
Yeah.
So just terrible start to the week. Commandment number 4 is pick the faster bank.
Yeah, so we've got 2 strategies for this. So one of which I call the insurance policy. So basically, and I've done one this week. So we've got a pre-approval probably about 2 months ago, and they've purchased on the weekend. They've only got a 5-day cooling off period. So the original bank we picked, their turnaround time has massively increased. So it's likely now that original bank we went with will not be able to meet the 5-day deadline. So we applied with another bank, which are very notorious, with brokers as being the quickest bank. So they'll approve it in 2 to 4 hours. We got approval on this one yesterday. So it's just doubling your chances of acquiring the property. Another one we have is if a better offer comes along. So we've got a pre-approval with one bank. If you come back 2 months later, banks are changing their variable rates all the time. So you may have gone with one bank because they're cheap at the time. All of a sudden they've gone up in interest rates. Another bank's come down. So we always review at the time. So we do the application at pre-approval, and then we review the bank again at full approval, and we can switch across if it makes sense to do so.
Interesting.
You're not locked in with that original pre-approved bank.
It just gives you a sense of what you have. Like that's at least your B plan, which is pretty cool.
Because normally you might have, Victoria may have 3 days for cooling off. So if your bank's taking 4 days, you've already lost the property. Typically New South Wales, you might have 5 days. If you're lucky, in this market where everything's selling very quickly, you might not get any. You might be looking at auction only conditions. So then you really need approval in 24 hours in a lot of cases. Otherwise, someone else has bought it, cash buyer, someone else with the quick bank, and a cheap interest rate's brilliant, but it means nothing if you cannot get the loan approved in time.
Why are some banks faster than others? Is it the rate? Is that one of the factors?
It can be if they've got promotions. So if a bank's doing, for example, if they're doing a refinance cashback, they might get flooded with thousands of applications because people want to refinance, and the assessors are bogged down just doing these refinances. So if you've picked a bank that's notoriously good for refinances, you're going to get bogged down with everyone else. So you want to go with a bank that's notoriously quick. They'll do valuations is a big part of it. So a lot of banks will do either a physical in-person valuation or an automated valuation. So the human one can take 1 to 5 days, depending on access. If you've got a pain in the backside tenant in there, who knows how long it's going to take for access. Whereas a lot of banks will do automated valuations. So you'll say, I bought at 700K, and the bank will say, yep, we agree. I think that's good value. And then we carry on. So within 2 minutes, we've got the valuation approved. So it's a lot of their technology, their ability to get it approved. Things like DocuSign, eSign, virtual ID instead of going to a JP or into a branch, and the valuations. That's probably the valuations is the longest piece there.
You use 700K as your main example. Is that the average that you see for first home buyers, or is it the sweet spot?
My average is around 700 for first home buyers. It probably ranges 500 to $1 million, something like that. I tend to default 700. Just as a reference point, really.
Random question. I find that really interesting. The fifth commandment is probably my favorite one that I'd like to unpack with you. So it's offset versus redraw. Tell us what they are and what's the difference.
So an offset is a different account to your home loan. So just envisage you just got your loan approved, you just settled, you got the keys. If you log into your internet banking, the bank will set you up with 2 accounts. One is the home loan account, which, again, going back to the 700, the 700 is the commitment you have to pay back at the 700K. You'll also have a separate offset account. So your whole life you've been saving money and making interest, but you got to think of the offset as a means to not to generate interest, but to save interest. So any amount that you have in there, interest is accrued daily and charged daily. So basically the number one way to pay off a loan quicker is to have money in the offset sooner. Really, you want to be building the offset up until the point that it reaches the same as the loan balance. So loan 700K, your offset might start with 5 to 10K. Let's be honest, a lot of first home buyers, they're all in. They don't have much cash left over. So the goal for me is to build up the offset account. So the offset gives you ultimate freedom. So you can pull out that cash for renovations, if you need to buy a car, if you want to invest in shares, start a business, whatever it may be, rainy day fund, you've got instant access to the cash. Whereas redraw, again, going back to the, log into the internet banking, the redraw is technically putting your cash physically into the home loan. So you're actually paying down the loan. So it might be 700K and then it's 699, 698. The restrictions for that are a lot of banks, if you want to then pull out the cash, they'll make you jump through hoops. So you might have to fill out a form, you might have to pay a fee. There could be a time delay. So it could take 7 to 28 days to actually release the cash. And next one, obviously check with the tax accountant with this, but in terms of the tax implications, and I found this the hard way when I bought my first place because I was using the redraw. So it's a lot cleaner for your first place if you keep your cash in the offset, because if you turn your property into an investment in the future, you basically haven't shot yourself in the foot from a tax deduction. So if you put it into redraw, you're paying down the loan. It means if you upgrade later, you buy a family home, for example, you've lost some of that tax deductibility. So I prefer to keep it in the offset. It's a lot cleaner. When you buy your second place, you can almost just drag and drop that
so if you've
offset
saved
against
up
the
a
new
couple
place.
100,000, you just go boom straight into the next. I like that. And offset, literally, you're offsetting. So if you've got 100,000 in your offset account and you've got 700,000 owing, it's like you're paying interest on the 600. Is that correct? Yeah. So and that is interesting. I always hear people talking about, from an offset perspective, it's actually dangerous. It's like a credit card because you can. It's not locked in. You can access that. Right, so it's not like once you've paid it down on your mortgage, you can't really access that again. The redraw you can if you pay a bit more. So the redraw is if you pay more, right? So I'm just trying to get it all clear in my mind as well.
Yeah, there's got to be a lot of self-restraint here, because if you're the type, if you like to go on sports bet, if you like buying nice cars, going on big European holidays, sometimes it's not the worst idea to put it into redraw. But I think 9 times out of 10, it makes a lot more sense to use the offset to future-proof yourself. You just need a bit of discipline because it technically does sit there. So if you've got 50K in that account, it is very tempting to just pull it out and be a bit frivolous. So it does take some discipline.
Personally, the rainy day fund is a good idea, I reckon. You park that, you build that up, and then, when you need it. But otherwise, you're paying less interest. Yeah.
Well, everyone seems to be having kids now. So, you probably need tens of thousands, because normally, the missus might be off work for 6, 12, 18 months. So you're on 50% salary. You've got an extra mouth to feed, all this other stuff you need to buy. So that's probably one of the big triggers. And, you might want to start a business in the future. So that's also your cash buffer,
it's a buffer
that allows you to do that, because you don't want to be tied necessarily with your employer. So if there is an opportunity there to become a contractor, start your own business, again, that's your starting cash to fall back on if cash flow is tight starting.
I love it. And you mentioned something earlier as well. So normally people are used to saving money and they earn interest on their savings, but you're probably earning 1-2% interest on that. Whereas with the offset, you're offsetting against 5-6% interest on your home loan. So I think offsets are very clever if you have the discipline. Certainly I use it. It makes a lot of sense. I'm sure you recommend it. So, all right, number 6. So commandment number 6 is broker fit. So you're for first home buyers. So obviously you fit for first home buyers. Tell me what broker fit means.
Well, basically, all we do is first home buyers for the majority of new clients, because I actually turn away a lot of business. I'm in a pretty fortunate position where I can say no to commercial SMSF, complex investors, all this other stuff, because I know my niche and I want to stick to my lane. I think for me, we get a lot of deals that people have gone to other brokers perhaps, or they've gone into the branch direct, and something's come up. So the assessor has said, what about this, that the broker or the bank hasn't necessarily considered. So I think if you're working with someone who's, 10 hours a day, all I'm doing is working with first home buyers. So I'm going to be better at that than someone who's doing it for maybe 1 or 2 hours a day, exponentially. So it's knowing the bank's policies, because every bank will have entirely different policies on who they lend to, how they lend, the different rules, time in your job. For example, a big one that's helped us recently is basically Combank and NAB will exclude the HEX from the assessment.
I've seen that recently.
So that's one of the big things that perhaps some banks or brokers aren't overly familiar with. We get a lot of other brokers passing us deals for guarantor loans because they fall into the complex basket, or they've just sent it to the wrong bank in the first place. And I sort of cringe sometimes. I think, why have you gone to that bank? It was never in their policy. So, it's a square peg in a round hole analogy. It was never going to get approved there.
Mate, I see on LinkedIn all the time, why would you do that? It's crazy. But it makes sense, right? If someone like producer PJ, who's sitting in the room with us looking for his first home, makes sense to speak to someone like you. Whereas myself, my wife, we're looking at buying something in an SMSF, potentially, starting to unpack that.
I'm not
makes sense to go to someone else. Yeah, it makes sense, right? But it's good to, I guess, understand your lane and know that. So that's
and I've got good partners as well. So we do get existing clients, and I want to be the go-to guy for my clients as well. So I've partnered with guys and they just specialize in SMSF. They just specialize in commercial. They're not a jack of all trades either. So I might have 10 different brokers that I deal with. They refer me first home. I refer them commercial, SMSF, whatever it may be, because that's their speciality. That's their bread and butter.
But it makes sense. You're building relationships too. So if you're with a young couple that's buying their first home, and then they'll come back in 5 years to buy an investment, I'm sure you want to continue to help them on their journey as well. So, but I guess if they're anyway, that's awesome. That's fantastic. So broker fit, number 6. Number 7 is one that I don't think many people think about. It's credit file cleanup. What's that mean?
Well, a lot of first-time buyers we speak to have never seen their credit score. They don't know what it is, what they've applied for, if there's anything adverse in there. Anyone with Commbank, you can do this within 5 seconds. So a lot of Aussies are with Commbank from the Dolomite days. So if you just fire up the app, on the home screen, there's a button in there for credit score. It takes you 5 seconds, and the majority of banks will use a service called Equifax. So Equifax is the sort of gold standard that reports all the repayment histories, all the open facilities. People have Latitude credit cards that they applied for a Harvey Norman sofa 5 years ago they didn't know they had. So it's anything, we don't want to undisclose liability. So we want to disclose everything. So reviewing the credit file, seeing what's open. Credit scores is a big one. People underestimate the importance of credit scores. If you've got credit cards that you're making late payments on, people like collecting Qantas frequent flyer points. So if you're churning 12 credit cards per year, that can have a big detrimental effect, because the bank assessors often get nervous that you've got too much credit. Is it a cash flow issue that you're moving all your money around these different credit card facilities? Maybe you've moved rental properties, for example. There could be an old utility bill that Energy Australia has been sending you letters in the post, but you don't live there anymore. So you haven't got these letters. They can place a default on your file. We can see defaults at $200. So it doesn't need to be thousands or hundreds of thousands of dollars. It can be peanuts, really. So we, as part of my service, we always pay to view every single application's credit file. And that's one of the biggest changes we made in our business, paying that tiny fee to see the credit file, because I'd rather see any issues before the assessor does.
Yeah, there's no hidden secrets.
Exactly. It's because if we apply, if there's something adverse in there, some banks want your credit file to be squeaky clean. Some are okay with it being, a couple of glitches here and there, and some are fine if you've got everything late almost, So we've got to fit the application based on the lender appetite for the credit file. So just pull up an Equifax. You can probably go to equifax.com.au, get a free credit score once a year, and it's probably one of the most underutilized pieces just to see your score. If there is anything negative, we've got credit repair companies.
That was my next question. How do you actually clean up a negative credit score?
Yeah, so again, referring it to the experts. So I believe their cost is maybe $500 to $1,000, something like that, depending on the severity. And you want to do this sooner than later, because it can take weeks, if not months, to try and pull these away. You've got credit repair companies. You might have someone chasing the debt. You've got the actual company. And then Equifax can take a few weeks to update their system. So we refer it to the experts. They can possibly remove anything adverse or late if it was a genuine case. And all of a sudden, your score can go from, normally scores from 0 to 1,200. So if your credit score's 300 because you've had late payments, it can then jump to 700 or 800 if we remove that. So that $1,000 you've spent on the credit repair company, that could save you hundreds of dollars a month, or thousands and thousands a year on the repayments, because all of a sudden, instead of being able to go with two banks who've got this really broad appetite but usually higher interest rates, we've got all these banks available now. So the more bank options, the better. Then we can be a little bit more picky, and then we can be a bit more picky with things like interest rates. So getting that done up front can save you thousands and thousands.
And I guess the difference is, so if a bank that's looking for a very squeaky clean score, they're probably going to give you a better rate than a bank that's open to risk. or more risk.
Absolutely.
It's a big one for us here at Coposit too. So and we haven't spoken about this publicly before, so the podcast listeners might be the first to hear about it, but we're working on a project called Coposit Ready, which is helping buyers understand their position and understanding their equity, their score, their credit score is a big one for us, and working with Equifax on that. So fantastic one. When we bought a property, the property we're living in actually probably about 5 years ago, more than that now, maybe 5 years ago. But the big one was my wife had like 5 afterpays going. Is that still, when we had to close those down, is that still an issue, stuff like that?
It was probably more so of an issue 5 years ago because the things like buy now, pay later just started appearing all of a sudden. So the banks didn't know. Banks always want to put you into a basket. They didn't know what basket to put it in. Is it a revolving line of credit? Is it a credit card? Is it a loan? There was just nowhere to put buy now, pay later. So what they did was they'll treat it like a credit card. So afterpay limit is typically, they're usually quite small, maybe $1,500. So they'll just treat it as a credit card now. But other banks will look at it as, especially if we're going for something like a guarantor loan where you might not have too much cash. If the bank sees the afterpay as a cash flow issue, so you're using it like a payday, you're using afterpay to get you through to payday, that's probably not the best sign to, if you cannot make your rental payments or if you're living with parents, if you're struggling there, you're probably going to struggle when you've got a mortgage. So I'd be very, very cautious with afterpay. Normally, most borrowers, I would, unless they've got a unbelievable application, I would just say, just close it.
Yeah.
Honestly, just get rid of it. It's going to be the easiest way.
Is that the same with credit cards? Because so people use credit cards differently. So you mentioned the people that are after the points, right? So if you use your credit card and you pay it off to zero every month when it's due, versus you're paying off the minimum and just becomes it's bad debt in my opinion. Is there do the banks view that differently, or is it better to just close your credit card if you're doing something, if you're looking to purchase?
Ironically not. So the bank they'll never really look at the actual balance. Yeah. It's more the limit. Gotcha. So let's say most people have let's say a 10K credit card, just for argument's sake. Yeah. So whether you're never using it, so it sits in a drawer, you never touch it, or you pay it off every month, they'll treat it as if the credit card was fully drawn at 10K for the next 30 years.
Gotcha.
So really it doesn't make too much difference whether you're clearing it. They'll still assess it, worst case scenario where it's there for the life. And typically credit cards will reduce home loan borrowing about 5 times the limit. So the 10K credit card that you never use could restrict around 50K home loan borrowing.
So exactly like what you're saying earlier with, say you've said you earn 80K a year, but that's including super, so it's actually 70 or what have you. Probably the same as that 10K credit card. It's a massive difference. We're talking 10 commandments for first home buyers. Number 8 is don't overshare. So this is probably information you need to give the bank, right? What would you not give to the bank?
A lot of that is a memo for me as the mortgage broker because I'm the filter as well.
Yeah.
So I would typically only ever ask for the bare minimum documents because I'm not here to make your life difficult. I'm not, I don't want to see 3 years worth of statements. We'll only ask for the minimum that the bank needs. So, for example, if you're an employee, a lot of banks don't want to see your tax return. So why are we sending in tax returns? Or they might not ask, they may only need 1 month's of statements. They might not need any statements. So why would we then send them 6 months worth of bank statements? Because if we send them the statements, guess what? The assessor's got to go through line by line and say, what is this F45 membership? What's this Uber Eats?
This is TAB.
So the banks actually tell us not to send the documents in a lot of cases. So they'll actively send email flyers and say, this is what we need. Don't send us anything more because if you do send it, we have to assess it and that can have an impact on there. So, of course, if these things, like you said, the TAB, the sports bet, anything in moderation. Yeah. It doesn't mean that you won't get your loan approved. It's just respective to your income. If you're on 100K and you're spending $50 here or there, it's not going to make much difference. But, if it's every night, $200, ATM withdrawals, that can have a bit more of an impact.
Do they know where you like if you withdraw near the casino? Would they know that?
In a
Or will you know
way,
that?
because a lot of people I see when we do see ATM withdrawals, it's a hotel. So
Gotcha,
they might be at the Red Lion Hotel,
Gotcha.
$300, $300 thrice. Yeah, they'll. I think a lot of cases do that. And again, going back to the basket analogy, they don't know which basket to put the cash in.
Yeah.
Because they can see all your Woolies spending, all your transport, all your insurance. That's fine. That's nice and easy to categorize. But where does all these cash withdrawals go to? It kind of always just goes in an entertainment basket, which can really push up your living expenses and ultimately just massively reduce your borrowing power.
Yeah, interesting. Okay. Number 9, commandment number 9 is property checks. So what happens if you don't check the property you're going to buy? What happens if you skip these?
Well, a lot of my clients, first-time buyers, particularly Sydney, would be buying strata. So get a strata report.
Yep.
If we go to beforeyoubuy.com.au, you can normally get a copy of all the strata minutes for the last few years. It's a big, long, boring document, and I'm not a big advocate of ChatGPT, but it's one of those rare uses where it's actually really good for home loan borrowing process, because you can just drag and dump it in there and just, is there any, you want to be looking for any special strata levies.
Yep.
So when I bought my first place, the agent was telling me not to get a strata report, which
is a big red flag.
Which initially made me think, I better get this bloody strata report. Turns out there was $30K worth of special levies because of waterproofing. The underground garage needed fixing. And turns out the agent actually at one point lived in the property. So he knew about all these issues, and he was actively telling me as a first-time buyer to not get this strata report.
Yep.
So we agreed on originally $530K. We got this strata report that cost $300. There was $30K of repairs, and I said, I'm pulling out this $30K because I need to spend $30K on strata.
Yep.
We then renegotiated at $500K. This is my own property, my first place. So that $300K report, $300 report saved me $30,000.
And I think that's interesting, right? Don't be scared by that. So just to explain as well, when you're buying in a strata, so maybe you're buying in there's 20 units or townhouses or what have you, the upkeep of the whole, all the common areas everyone's responsible for it, like everyone that lives there. So you will pay a strata levy, maybe quarterly. Now sometimes, and that money gets saved up, and typically if you look at a healthy strata report, there might be money saved up, for rainy days, for when they need the roofing done or need to rip out the gardens and start again or what have you. But sometimes there are expenses, and that's just general upkeep. So if you bought a house that you own on your own, you're going to have to there's upkeep for that house as well. So you're sort of paying that over time anyway. But sometimes expenses grow, and there might be a massive issue that needs to be rectified that wasn't sort of part of the planning. So you would strike a special levy. The strata would strike a special levy, which means they're paying more over a period of time or at a certain amount of time. And I think it's fine if you understand that, because as you say, you can go, hey, there's 30 grand here that I'm going to have to pay for on top of buying this place, so I want to negotiate. And I think that's interesting.
Yeah, it's a really good tool to go back and negotiate. And I mean, that's more so for units. So, townhouses, villas, units, apartments, you'll get the strata report or the body corporate report.
Yeah.
If you're buying a home, like as in a house, you'd want to get a pest and building report.
Yep.
So again, that can be a wonderful tool, firstly to find any rectifications. I'm not a builder by any means, and I have no idea. It's normally a 50-page report, which I don't have a clue. So I normally just pick up the phone to the pest and building guy and say, can you give me this in layman's terms? There's cracked tiles here. How much is that going to cost me to fix?
Yeah.
It might be $500.
Yep.
So it's not too significant. But if he says, there's termites in there, the whole thing's falling apart, it's going to cost $30K to re-stump it or, do all these rectifications, then you've got two options. So you can either just choose to walk away if you don't have the cash, or you can say, look, we've had this pest and building. It's going to cost us 10, 20, 30K. I don't want to pay that.
Yeah.
and the next person who buys the property is also going to find the issue. So it can be a good renegotiation tool. And we see a lot where you may purchase a property at a price, do the due diligence in the cooling off period, and then renegotiate. So it can be a good tool for that. So for the sake of $300 for a strata report, $600 for a pest and building, don't skip those.
It can save you a lot, right? And look, it's an emotional time as well. So if it's your first time buying, especially if you're going to live there, you can panic, I guess. And the last commandment is don't panic. Do you see this a lot?
Yes. So we'll have, emotions two ways. So probably first one is, a lot of it is just overpaying. You know, you go in with your partner, you both fall in love with it, you see yourself living there, you've moved your furniture in almost in your head, you've, told your parents about it and your friends, you're almost having the housewarming party before you bought it. So, you've got to just be conscious that you don't want to overpay for the property, because it's going to take you years to possibly save that money back. And obviously your mortgage is a lot bigger in the meantime. And also just going through the home loan process as well, because everyone wants things done instantly, but it takes a little bit of time to get the loan through. So just think logically, trust in your broker, and just be patient with the process, because it can take a few days as well.
I love it, man. 10 commandments. I'll recap them for anyone that's going to see a little clip on Instagram or TikTok and want to listen to the whole episode. So the 10 commandments for first home buyers with Aidan Hartley from Our Home Loans, the first home buyer mortgage broker. So 10 commandments. Number 1, you don't need 20% deposit. Number 2, LMI, avoid it if you can, pay it if you must. Number 3, pre-approval first, always. Number 4, pick the fast bank. Number 5, offset versus redraw. Understand what that means and what's better for you. Number 6, find the broker fit. Number 7, clean up your credit file if you need to. Number 8, don't overshare with the bank if you don't have to. Number 9, get the right property checks. And number 10, don't panic. It's very emotional, but you'll get it done and you'll find a place. That's awesome. Do you have any scary stories where it all fell apart? And then I'm going to ask you if you have any amazing stories where all the boxes were ticked and it just worked perfectly.
Well, my job is to avoid the scary stories.
Good.
So yes and no. So most often, as I alluded to before, they've gone into a bank, they've got an automated approval, or it could even be that person's moved to a different department and your pre-approval's been wiped. So we do get a lot of panic, or they've gone to the online bank and they've inflated their figures, and they go to full approval, and all of a sudden the human assessor says, nah, you cannot get that. And you only find that out once you buy, so it's a bit of a risky move. So my job is to find another way. So that could be to get a bit more cash if you can, add in a guarantor. Most of the time we just end up switching banks. So I've been doing this 13 years and I cannot recall one single instance where I haven't been able to find a way for them to ultimately buy, because there's always a different angle. You just need to look at it differently. Worst case, we've moved to a more expensive bank. So you may have a bank, everyone wants the cheapest rates, but we may have had a dirt cheap bank that they've got that they haven't been able to get approved for. Sometimes you can go to a non-bank lender. So you could go to Liberty, a Pepper, Latrobe. Yes, it's more on the interest rate, but it helps you acquire the property, and it's mostly a stepping stone loan. So you may then, in 12 months' time, good repayments, we can just switch it back to a major. Everyone's happy.
That's really interesting. Between recording this and this episode going live, there may be an interest rate decision, which is really interesting, right? We've seen rates start to head down. The tricky one is, I had an economist from CBA with me a few weeks ago, and she said, rates are definitely trending down, and the next meeting could see that, right? My question is really, do you think the banks will pass it on? Because I'm starting to see a little bit of this in the media. What does that mean if they do? What does it mean if they don't?
Yeah, well, ironically, I did an article on news.com.au and realestate.com in July 2025 around my thoughts on this. And this was posted on the day of the RBA cuts. And here was I doing this whole article around, they're definitely going to cut the interest rates. And it turns out they didn't. So it was a bit of an egg on my face to, maybe I'll stick to my lane as a mortgage broker and I'll leave the predictions to the economists. But to be honest, 95% of people thought that rates were going to be cutting. So my take is, and this was the point of my angle on this, was I don't think from here on that the banks will pass on the full interest rate cuts. We've seen it happen before. 2019, 2020, banks were, the RBA was decreasing rates at a rapid rate, and the banks passed on the first couple, but anything post that, they were only passing on a portion of the RBA. So, for example, the RBA reduced by 0.25% on the cash rate, and the banks were only passing on 0.15 or 0.2. So they were just a bit of a reduction in the RBA cash rate, and they were just pocketing that cash, which, it's their prerogative to do so. It's their money. They can lend it to however they want, because they'll always say that the RBA is only one source of where they acquire their funds from. So few banks did allude to that when they did pass on the rates a few months ago. They said, it is only a portion that we're getting it from the RBA. So to me, that indicated that the next one, they might not be as generous in passing on the full.
Will that make things more competitive as well? Like, is there opportunities, for negotiation with your banks if that's the case, if some are giving the whole amount and some aren't?
Absolutely. It can really bring out some heroes as well, because if one bank is passing on 0.15 and then all of a sudden the next day someone passes on the full 0.25, everyone's like, wow, this bank's amazing, let's go and refinance to them. So we get a lot of inquiries around those time, but to be honest, it is just a profit making scheme. So they may pass on 0.15, for example, but often if we ask nicely, if we ask the right person, they'll give it in full in a lot of cases. Or if you do move to another bank, for example, you'd have to trigger the refinance process. You'd pass in a discharge form. Often then the banks prick their ears up and go, let's keep this, it's 0.1%. We'll just give it to you, and everyone's happy.
Okay. It helps to have the right broker as well, I suppose. Our home loans. Give us the plug. How do people find you, Aidan?
So most of my social media, if not all of it, is through LinkedIn. So follow me on LinkedIn and owlhomeloans.com.au.
Love it, man. Thanks for your time.
Thank you, Michael.
We'll talk soon.
Thank you. See you soon.
This is Jason He, the sexiest voice in property, here to tell you that the Property Now podcast offers opinions on Australian property news for informational and entertainment purposes only, and general in nature. It does not take into account your objectives, financial situation, or needs. It does not constitute professional advice. Always seek expert guidance before making any property-related decisions.